A bank, when they lend money, wants to protect their position. Their principal objective is that they should receive repayment of the loan and the interest on the due dates without any risk at all. That's what a bank wishes to achieve. Because of this, they believe they have a legitimate right to interfere with the company's business to ensure that the risk profile isn't changing. That's what they're going to try and do. A borrower, on the other hand, has a completely different interest. They want as little interference from the bank as possible. If you're a borrower, once you borrow the money, you don't want to hear from the bank again. Ideally, you don't want any constraints on your freedom to manage the company as you would want to manage it. And you don't want to have your time wasted by the bank getting in touch and telling you to do things and so on. So the parties start a very long way apart. Where they end up in the middle depends entirely on the state of the capital markets. Back in 2007, when banks were lending to anybody, they were lending 125% mortgages to unemployed dropouts in trailer parks, for example. The terms of the loan were very much borrower friendly. Then after the 2008 crisis, it went completely the other way when banks wouldn't even lend to each other. So it depends on the capital markets. The lender wants as much control as possible so they don't see the risk to their loan increasing, and the borrower wants to have the attitude, don't call me, I'll call you. And from those two extreme positions to start, we get to an agreement somewhere between those two extremes, depending on the capital markets. Looking at it from the lender's point of view to begin with, what a lender wants to do, they have three objectives. They want to make sure that the loan is only used for specific purposes which are stated in the loan request. Secondly, they want to limit the borrower's business. If they've lent to an advertising agency, for example, they want that business to continue to be an advertising agency. They don't want a sort of subsidiary fish and chip shop to be set up because the risk profile will change. As a company goes away from its original plan, the risk profile changes. Therefore, the bank wants the opportunity to ask for its money back under those circumstances. It'll be an event of default if the business changes, or they want more security, higher rate of interest, wider margin, and so on. So they want to limit the borrower's business, and they want to monitor the borrower for early warning of trouble. Any sign that the borrower is unable to pay, whether lights flash amber, the bank wants to go in and do something quickly rather than let the situation deteriorate. In order to achieve these three objectives, the bank will want various protective clauses, which I'll discuss in greater detail in other videos, but the protective clauses they'll want are preconditions to start with. The preconditions will prevent the borrower drawing down any money having agreed the loan until these preconditions are met. So they want to make the loan subject to preconditions. They'll then extract representations and warranties from the borrower regarding the continuing nature of the business. So they'll represent and warrant that the business will remain within a profile which initially induced the bank to make the loan. They'll then extract covenants from the borrower. These are promises that the business activities, the financial condition, and the assets of the company will stay within the limits that originally induced the bank to make the loan. The bank will also organise or define events of default. These events of default are circumstances which will enable the bank to demand that the loan is repaid. Something's happened which has changed the original view of the bank towards the company, increased the risk, and therefore the bank wants the opportunity to ask for their money back if there's been an event of default. And then they'll take security over the assets of the company. So if they want their money back and the company won't pay it back, they can seize the assets and sell them to get their money back. So with that, those type of clauses, the bank can feel entirely safe that if the risk changes, they can get their money back. Belt and braces, they will also consider the capacity and the authority that the company has to ask for the loan. First of all, the capacity. The bank will check the memorandum and articles of association to ensure that the company has express power to borrow the money. And if it hasn't, they'll want the articles of association memorandum changed to give the company express power to borrow. And they also want to ensure that the directors of the company have been given authority to sign the loan agreement. Therefore, what the bank will want as a precondition, they'll want a quorate board meeting to take place where the terms of the loan are fully discussed by the board, and the directors who are going to sign the loan agreement are given express power to do so, and the bank will want a certified copy of the board minutes to establish that that's happened. So the bank wants to protect themselves in those particular ways. The borrower, on the other hand, if we change hats, and now we're in the position where the borrower wants to say, well, don't call me, I'll call you. They won't be permitted to do that, but that's what they would prefer. What the borrower wants to do with this loan agreement is to eliminate irrelevances. The bank will produce a standard loan agreement with pages and pages of representations and warranties, a lot of which will be irrelevant, and so these must be knocked out by the borrower. They should delete any representation or warranty which is superfluous to the credit decision, had nothing to do with the decision on making the loan, and is superfluous to the bank's subsequent protection, the protection of the loan. Anything that's irrelevant should be knocked out of the agreement because it could have unintended consequences. Then the borrower should try and promote ambiguity in the loan agreement, using words like material and reasonable. So if there's a phrase that says at all times, the borrower should change at all material times. Brings in uncertainty. If something can happen in the bank's opinion, it should be changed to in the bank's reasonable opinion. It brings reasonableness into it. The borrower must also have various de minimis amounts below which something doesn't count. So we'd have exemptions and exclusions and thresholds on various preventions which the bank's putting in to run the business. We must try and take out any ambiguity. Some words must be tightened up. Where it says might or could, we want will or should. And so we make it slightly less harsh. That's what the borrower should wish to achieve. So the parties start a long way apart, and depending on the capital markets, we will come to an agreement in the middle somewhere, which we'll discuss during the rest of this course.